You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before we start this program, I want to remind you about a couple things. One is that this podcast lives on a website called wealthformula.com. Wealthformula.com has got lots of resources in and of itself that are worth visiting and checking out: webinars, books, all that kind of stuff. You can also sign up for some of our groups, like our investor club, if you're interested in potentially getting off the sidelines, getting involved with some investments, if you are of the accredited investor type, that is, of course. Also want to remind you, and this may be the last reminder for this because we only have about 20 spots left for our April event, our meetup, the Wealth Formula Meetup, which is in Phoenix. It's on April 22nd and 23rd. It's just a big party, fun lectures, buses, but cocktails and a lot of socializing. This is a really special event. Everybody who goes to it is always super happy that they did. And a lot of times it's as much about what they learned as who they met, right? The people who they met is sometimes even more valuable on an ongoing basis. And so go check that out. Wealth Formula Events with an S.com. Again, that's wealthformulaevents.com. And with that, let me talk to you a little bit about what's going on. As you know, well, you probably already know more than I do because I am recording this podcast on the Ides of March. If you recall the Julius Caesar, the warnings on March 15th. Well, anyway, this is one day before the Federal Reserve meets to discuss the economy and its plans for the near future. Now, the 900-pound gorilla in the room, of course, is inflation. And although the war in Ukraine may be somewhat of a mitigating factor for the impending hawkish moves anticipated, rates are probably going to go up, right? And by the time this post, or I should say this recording is published, the podcast is live, you're going to already know a lot more than I do right now. And let me guess what happened. There was an increase in the Fed's discount rate of 25 basis points, or otherwise known as 0.25%. I'm not clairvoyant, even though I'm talking about the Ides of March and all that kind of stuff. But that's what's baked in the markets already, and the equity markets and all that. And what will dictate any further movements after Wednesday is really going to be about what the Fed says with regard to further rate hikes and the disposition of its bond portfolio and all that, and all that stuff. So, okay. So you already know more than me, but so you're already seeing what's happening. You have a pretty good idea. Maybe the market's reacted again. And so what do you do about it? Do you panic? Do you stop investing? Well, here's the problem with that, right? Because that's the knee-jerk response, right? It'd be afraid and just freeze up and not do anything. But remember, why are the rates going up in the first place? Yeah. It's because of inflation. So what happens to your money in your bank account during inflation as it's sitting there getting, far less than 1% per year growth? Well, it loses money, right? So if you've got 6% inflation and your money's growing at 0.5%, that means you are guaranteed to lose about 5.5% per year, and it loses value. So keeping yourself in cash during these sort of uncertain times, no, I'm not saying don't keep any cash. It's not what I'm saying at all, but just be aware that, the more cash that you keep, that cash is pretty much guaranteed to lose value, right? I mean, so you're not necessarily doing anything conservative by guaranteeing losses. At least I don't think of it that way. So in order for you to, in this kind of inflationary market, you have to, you just even to break even, you're going to have to be making, 5-6% on your money. It's crazy, right? So the question is, what am I doing? Because that's what people want to know. And I'm not giving financial advice because I'm not I am not qualified to do so. I don't have those special certifications that you can get in a month or two. But what am I doing? I'll tell you what I'm doing. I'm still investing my money in the same assets that I've been doing all along and that are hedged for inflation. Because the good news is that I don't have to change my investment strategy at all because, well, mostly what I do is multifamily real estate, and that happens to be a great hedge against inflation. But Buck, you ask, won't cap rates go up with interest rates? I mean, I see this question all the time. We do a webinar that's always, well, what are we going to do about cap rates? Well, typically that is true, right? Although it's not necessarily that cap rates go up linearly with interest rates. But, let's go a little bit deeper on that question, though. Ask yourself once again, why would mortgage rates go up in the first place? Of course, they follow the 10-year treasury. The 10-year treasury follows inflation. Yes. And yes, inflation, when that happens, mortgage rates go up because the 10-year treasury goes up, and the 10-year treasury went up because inflation went up. And guess what else goes up when inflation is up? Rents. That's right. In other words, increasing rates is hedged by increasing rent. So again, it's all baked in. It's all baked in there, right? So I am not too worried, frankly. Now, to be clear, I'm not saying that we have nothing to worry about. There is a Chinese curse that says, may you live in interesting times. And like it or not, we live in interesting times with plenty of danger and uncertainty. And all we can do during this time is to be rational, to be disciplined, and think about how we allocate our money, and not just to be ruled by fear. How we allocate money may not be the same, by the way, if you live other places, if you're in different situations. Here in Russia, and you'd be probably trying to buy Bitcoin as quickly as possible. You're probably too late now. Your ruble's worth nothing, but you got that currency risk that they've got, and you might try to do something else and hang your money somewhere really quickly. But in the U.S., the more reliable hedge, I will say right now, my humble opinion, might still be good old-fashioned multifamily real estate. Some of these boring assets that I always talk about. It's a complicated topic, though, this whole thing, what's going on in the world and how it's going to affect the markets, how it's going to, trends, investing trends. And that's exactly why we're going to keep talking about it. And that's what we are going to do with our guest on this week's Wealth Formula podcast, David Sacco, when we come back right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast is David Sacco. Now, David is a practitioner in residence of finance from the Pompeia College of Business at the University of New Haven, and he has become a nationally recognized expert in investment trends and analysis on the stock market, inflation, cryptocurrency, and Dogecoin. David, welcome to Wealth Formula podcast.
Thanks, Buck. Thanks for having me.
We're going to have to come back to that Dogecoin part in a minute, but let's start talking a little bit about the 900-pound gorilla in the room. I think that's what everybody's worried about. As we record this on the Ides of March, we are a day away from the Fed's meeting or announcements. The plan presumably is to raise interest rates to address the inflationary environment that we're in. What do you think the Fed's best options to combat inflation are right now?
Well, unfortunately, I don't think they have too many good options. I'm pretty sure that Powell telegraphed today or yesterday that they're probably only going to raise rates 25 basis points. I think, before the last few weeks, there was a possibility that they would go 50. I think if all they were having to deal with right now was the fight against inflation, they probably would raise rates a little bit more quickly. But obviously the war and the impact that that's had on the energy and financial markets has created a level of uncertainty that the Fed just, doesn't like to deal with. So I think they'll go 25, which, will help start what they need to do. But ultimately, they'll have to pick up the pace. And I think they're just a little worried about the uncertainty related to the war right now.
Well, that's a good point, which is basically that the war, it's got an interesting effect because it's also increasing the price of energy prices. And that's, that we're feeling the effects of that as well, in addition to the inflationary environment that we were already in. So I guess the idea is there's volatility in the world, and therefore maybe we shouldn't be quite as hawkish about this right now as we might be otherwise.
Yeah, I think, but it actually put the Fed in the box. So the way I like to think about it is that demand pre-Russian invasion of the Ukraine was sort of like a rubber band that was stretched pretty taut, right? So demand was creating a lot of pressure. That was creating the price pressure and inflation. The war and the impact on the oil market sort of added to that pressure, right? So, normally to sort of combat rising prices or inflation, you sort of, raise interest rates, and that sort of puts the brakes on demand. But at the same time, the wars created all these other uncertainties, right, about what could happen. And we saw that in the stock market last week. So the Fed's task is to sort of tap the brakes on the economy without bringing us to a crashing halt, which is it would have been difficult before. I mean, the situation that we were in because of the recession related to the pandemic and how we came out of it and made that very difficult to begin with. And the war just exacerbates that. So this is probably the toughest situation that any Fed has faced, I'd say, since Volcker back in the early 80s. I mean, I would even put this, 2008 was pretty rough too, but, 2008, there wasn't any debate about what needed to be done, right? Because it was just a complete meltdown. This one's a little trickier because the economy is generally doing well, but you got to just resist the urge to slam on the brakes and throw us into a recession.
And then I guess that's the next question is, is it possible really to eliminate inflation without triggering a recession?
Again, we'll get into the sort of what's your definition of a recession. Well, the way the Fed reduces inflation is they slow demand, right? They raise interest rates. That slows people's spending. It makes it better for people to save money now and invest it and then spend it later. So you're slowing the economy to tame inflation. And the recession is just definitionally, a slowdown of a certain amount for a certain time, right? So You have to slow the economy, which is what starts a recession. So it'll be difficult to not have, what I would at least call a, relatively large economic slowdown if we're going to get inflation under control. Because remember, it's not just a U.S. phenomenon, right? This is going on globally, right? Every central bank around the world, every big monetary authority use the same playbook, and we are seeing the effects of that.
I'm curious kind of your take on how this affects, the equity markets, real estate markets and such, because, certainly you would think a slowdown or recession would, potentially hurt the markets, but we've seen sort of a lack of correlation, particularly during COVID. We had what was the biggest recession in history. The stock markets act like it didn't even happen. So what do you think happens there? I mean, I know you're interested in the market trends as well.
So remember, when we see interest rates start to go up, that has, obviously it creates a situation where equities become less attractive to fixed income investments. But interest rates are still so low that comparison, I don't think is that valid. I mean, if interest rates were at 4, 5, 6, 7%, then I think maybe we have that conversation. So park that, on the equity front for a second. At the same time, the equity markets are forward looking, right? So your analogy about the pandemic is a good one, right? Because obviously when the pandemic hit, and it's funny, I'm in the same place I was 2 years ago visiting my son in Charlotte, North Carolina, when the economy shut down. And, the whole economy turned into a ghost town. Now, about 3 weeks later or 4 weeks later, we kind of realized that it probably wasn't going to be that bad of an economic event. So the markets sort of looking forward said, okay, we're going to have a recovery. The government's going to throw a lot of money into people's pockets in the form of direct stimulus. The Fed and other central banks are going to engage in easy monetary policy. All of that really bodes well for a real big economic expansion, which in fact happened. So I think the stock market right now is sort of thinking about, okay, what is happening next? Now, there's still tons of investable dollars out there. Economies are, the problem with inflation is that the economy is growing too strongly. Well, on the one hand, that's a very good thing for the stock market. So I think the stock market is sort of taking the, at least, uncertain nirvana approach right now, which is assuming that the Fed's going to be able to pull something off without cratering the economy. And I think that's why they're a little bit more sanguine about things going forward. The real estate market is an interesting one because, again, when rates go up, you would expect that to put pressure on housing prices because it makes mortgages more expensive. At the same time, what we haven't seen in 20, 30, or 40 years we've seen asset inflation, but we haven't seen price inflation. So, when interest rates go up because of inflation, on the one hand, that's going to, retard investment in real estate because of higher interest rates. But on the other hand, the inflation itself sort of helps boost asset prices. So you've got, things pulling in both directions. And I think the market is still relatively positive right now.
In terms of commercial real estate, I think the interesting thing is, and I'm big in the multifamily market myself, and I often get this question about, what to do given the possibility or the probability that mortgage rates are going to go up. And in situations like that, I think we also have to put into context the idea that, well, why are they going up? They're going up because of inflation. And what does inflation suggest? Well, I mean, certainly for a multifamily investor, that means your rent's going up too. So you may have a little bit of a hedge there. Do you feel like there's, do you think that's true? And maybe could you, talk about other situations that may have parallel offsetting type situations like that?
Yeah, so absolutely. I mean, there's the rent component, and there's also just the price appreciation of, when inflation goes up, all real assets increase in price, whether we're talking about gold, real estate, and I think, the other thing that's happened, and this is, exacerbated, but also started by the pandemic, is the shift in mobility, right? Now that we've gone through this transformation where people are not tied to a geographic location because of their jobs, we've seen this kind of steady growth in real estate prices in a lot of different areas, right? You can basically take your job now and go work anywhere. So that's sort of a structural change that I think is profound enough that it's going to eat up a lot of the lower demand that will result from interest rates going up, right? I think there are plenty of people still out there looking to relocate, looking to move maybe away from urban areas or just move to a different area because they can now move with their job. So that's going to help keep a bid. And the other thing, your point about multifamily is a good one, because as much as prices of homes have gone up and there's still a pretty strong bid, prices of rents are starting to outpace that. So you're that sort of arbitrage between buying and renting. Well, if you're an investor in multifamilies or you're buying places that you're going to rent, you're right, that rent is outpacing your cost. So there's more profit in that trade as well. So a lot of conflicting things, but you're absolutely right on that property front.
You talk a little bit about, we of course in the U.S. we're kind of looking at what's going on here, and we don't have a good sense of what's going on in the rest of the world. How is the current crises, whether it's inflation, the war, affecting some of our, major partners or nemesis in the world, like say China?
So I would say, it was funny, I was just speaking with someone else about inflation, and we were talking about what it means for the dollar. And, the thing about inflation, when you're talking about different countries and different currencies, what you care about is the relative level of inflation, right? So because inflation is pretty consistently high around the world, right? Because of, again, most of the world responded to the pandemic the same way. Most of the world used the same toolkit in terms of fiscal and monetary policy. So inflation is rising steadily around the world. So I don't think that's going to cause a huge change in currency rates or balance of payments, because everybody is experiencing the same inflation. But there is this dynamic that's going on now, more so I think related to what's going on with Russia and the Ukraine, in terms of the dollar's role as the reserve currency of the world, which, it still is by far, right? I mean, if you look at international trade, 60% of international trade is done in dollars, 20% is done in euro. And I think the Chinese currency is less than 5%, right? Which, they're underweighted in terms of their currency in international trade relative to the size of their economy. So, I don't think we're going to see too much change on that front, because what gives the dollar value isn't really anything that we do. I mean, it's the underlying strength of our economy, and it's also the perception that people put into it, right? They want dollars, right? Even our worst enemies out there geopolitically still want dollars because it's such a stable currency, right? Russia right now, right? The sanctions we're imposing are because Russia needs dollars, right? Because their currency is depreciating, and the only way they can maintain what they're doing is to have a stable currency. So I don't really see a seismic shift. I mean, China will try to tweak the rest of the world. They've been trying for 15 years to get people to move away from the dollar as the reserve currency, but there really isn't a viable option just yet. And I'm sure we'll talk about that when we go on to crypto in a little bit. But
yeah, it's interesting to me about the whole Chinese thing too, is that they have, in my estimation, their primary goal has really been to be seen as the world's economic leader, and take over that role of the U.S. And this whole conflict, and I think their lack of joining the rest of the world in condemnation has really hurt that. It's sort of an aside, but I'm curious if you have any thoughts on that.
Yeah, I mean, look, I tend to focus on these issues from the economic perspective.
Right.
Less so from the geopolitical, because
but don't they kind of affect each other though? I mean, if you're going to be a geopolitical leader, you're gonna have to have that respect of.
They do, but here's what I would push back is the following. So what we've done, for instance, with Russia, where we've cut off our importing of Russian oil, which was marginal anyway, right? It was only like 3 or 4%. We haven't done. Now, remember, if we really wanted to cripple Russia's economy, we could completely deny them access to the dollar market for any oil. So even the nations that continue buying oil from them, we could essentially freeze their dollars and not let them have access to it. Yet we're still willing to do that, right? So ultimately, now again, there's probably very good reasons, one of which is Russia could actually interpret that as an act of war and might escalate things. Right. But the point is, everybody always winds up being somewhat pragmatic in what they're doing. And I think, is in this, obviously, it's an awful humanitarian tragedy. But, hopefully it resolves itself sooner rather than later. But I think 10 years from now, it'll be in the rearview mirror, and everybody will just be focusing on the economic issues of the day, which take precedence.
So one of the things that I guess that leads us to is, I'm a Russian citizen, and I have an idea that this is about to happen. Personally, I'm thinking about moving a lot of my rubles into Bitcoin if possible. Did that happen?
I don't think so, just because of the price action that we saw last week, plus the fact that, Russia pretty quickly, I think, to cut off. Now, they have a very sophisticated tech community out there, so I'm sure a lot of their citizens have found ways around that. But I mean, here's the thing. The people who hold most of the assets in Russia, the oligarchs, weren't holding their assets in Russia to begin with, right? They're all offshore in dollars, in euros, right? That's why those guys have those, $500 million yachts and the $20 million apartments in New York and London. So I think the bulk of Russian wealth was already held outside the country. Your point is correct. I mean, when the ruble, took a bath in the last few weeks, that certainly is going to hurt the average Russian citizen. But again, only to the extent that they had to buy imported goods, which there probably weren't that many anyway. I mean, I think, unfortunately, the average Russian citizen had a pretty poor standard of living before Russia invaded Ukraine, and they still have a pretty poor standard of living. So I'm not sure it's had a huge impact. Obviously, Visa and MasterCard shutting down are going to affect, some of the middle class in Russia. But I don't think, they do such a good job of controlling the narrative that I'm not sure it's going to have, much of an effect on certainly getting them to be, a regime change or anything like that.
One of the arguments that I think, cryptocurrency, particularly Bitcoin proponents, have had for years now, which I don't know that I believe in Bitcoin. I own it. What I don't necessarily see it right now as an asset that is somehow protected against other markets. To me, it's not right now a protection against. It's basically rises and falls based on what the other markets are doing. What is your take on that?
Yeah, so I think in the last 6 months, what we've seen is that Bitcoin has basically become pretty correlated with the Nasdaq.
Right.
So it's sort of a higher risk, right? It's not not a blue chip stocks, but it's sort of a higher risk asset, and it moves pretty much in tandem with that. Slightly bigger moves up and down, but it's pretty correlated to what Nasdaq's done. So I think the way the trading community views Bitcoin is that it is just in that category of what we would call risk assets, higher leverage than normal stock trades. And I agree with you. I mean, look, could Bitcoin ultimately become sort of a version of digital gold? Possibly, but it's not there yet, right? I think what's intriguing about Bitcoin is that what we've seen from central banks in not just the last 2 years with the pandemic, but the last 30 years of financial crises, is that every major currency around the world, ultimately, there's some central bank that can use that currency to manage their domestic economies, and they have some control over it. So, what Bitcoin, and again, I wouldn't say all cryptos, because there's, dozens, if not hundreds of cryptos, right? So the first shakeout is going to be which is the crypto that becomes what we think of as crypto going forward. Right now, it's probably Bitcoin as much as anything else. And then does there become enough global demand for people to rely on that? Not just, in the sophisticated investor community, but, what I'm thinking more of is people in underdeveloped economies who literally suffer as their currencies fluctuate on an everyday basis. Yeah. I think those are the people that potentially could have a lot of value for, because, they won't see that standard of living fluctuation that happens with weak currencies. But there's a lot of time between now and then.
Right. I mean, it's hyperinflation in Zimbabwe versus Bitcoin volatility. I mean, you'd still probably take the Bitcoin volatility.
Exactly. Right. El Salvador, so the fact that countries like El Salvador are making that move, again, it's highly symbolic, but, if the technology is stable enough in the rest of the world, i.e. meaning that those people in those poorer countries actually have cell phones and actually can access their digital wallets or maybe even local, crypto platforms, then maybe there's a chance. But, again, we're talking, years away from something like that even becoming a seed of an idea.
My view on cryptocurrency has largely been this idea that for the most part, there's Bitcoin and then there's everything else. And Bitcoin, for the most part, has been accepted to some extent by traditional money, Wall Street, as some type of digital gold, and it's here to stay. Everything else is essentially, in my view, kind of a software company. It's like some sort of a software startup or tech, but obviously it's decentralized, so it's different. Out of that, first of all, I'm curious your thoughts on that. Second of all, what cryptocurrencies do you think are out there that are doing something that might make it, more dominant in the future?
So it's interesting. So my background is in financial markets, right? So I approach this, purely from the sort of trading and investing perspective. And the part of crypto that scares the heck out of me is the technology side, right? So I sort of understand how blockchain works, but I'm not a blockchain expert, right? So my understanding of Bitcoin is, the algorithm is such that there's a diminishing amount of Bitcoin. It basically becomes a finite asset. The way crypto vaults work, they're essentially unhackable. And again, my belief in that just comes from the fact that I know that there are hundreds of billions of dollars of Bitcoin that's lost and locked up. So if someone had a way of hacking into it, there's a huge financial incentive to do it.
Right.
The rest of these currencies, I don't know enough about and to really opine on them, right? Except to,
Sure.
And then ultimately, remember, whether we're talking about Bitcoin, gold, US dollars, or euros, it really has nothing to do with the underlying technology or who's writing the pieces of paper. It has to do with people's belief in it, right? Yeah. And we don't know how that's going to play out. I mean, right now it seems to be Bitcoin and maybe to a lesser extent Ethereum. But I've also, I mean, I can't believe this is true, but I've heard of, these sort of scandals where, someone literally just creates a cryptocurrency, goes out and sells it, and then, and there's not even any scarcity associated with it, which, we saw that with meme stocks a few years ago. I mean, there's sort of the power of markets, which obviously is huge and is big, and then there's also some underlying sense of reality, and I'm not sure where we're at yet on cryptos. So it's going to be a learning process.
Although I do see, at least in your bio, it mentions that you have some opinions on Dogecoin, of all things. Is that accurate?
I'm not actually sure how that got into my bio. I got to be honest with you. So again, Dogecoin is the perfect example, though, right?
Yeah,
because it was created as a spoof. Elon Musk says something. So I would say Dogecoin is that end of the spectrum. For instance, I don't even know if Dogecoin has the same type of algorithm that Bitcoin does. Right? Does it actually have that self-ending algorithm where there's some scarcity associated with it? Is it as technologically secure as Bitcoin seems to be? I don't, this is where we need, some computer scientists to help us, because look, my biggest fear is you wake up one day and somebody has figured out a way to crack the Bitcoin algorithm, right? And then all of a sudden it's a printing press. So now, again, that fear is no different than the fear that we wake up one morning and we go onto our banking account apps and there's all zeros there, right? Because theoretically that could happen as well. Mm-hmm. So, there's just a lot of technological uncertainty because the technology is constantly evolving and we don't know what's next. So in my role as a Bitcoin expert, and I say that with parentheses around it, I'm often asked to give investment advice. And my advice typically is don't invest more in Bitcoin than you're willing to lose tomorrow, right? Because, that's and that's okay. I mean, look, as part of any investing strategy, having some high risk assets is okay, right? But, you have to have the right percentage of them. And obviously that depends on, your stage in life and all of that kind of stuff.
What is your take on, not necessarily investment advice per se, but my listeners they're investors. And so when you look at what's going on with the Fed, when you look at the war, the volatility, what is a good way to frame this for an investor looking at allocating money for their own, for their own net worth?
Sure. So let's go back to where we were, let's say, 2 years ago, right? The pandemic hits, stock market gets annihilated. And then, like I said, roughly 3 or 4 weeks after that, I think that we sort of knew that things weren't going to be that worst case scenario that the market was pricing in, right? Mm-hmm. So, at a time like that, you can sit there and look and say, okay, what is the symmetry of risk? Well, I think the symmetry of risk back then was that market was more likely to go up than it was to go down, right? And then obviously since then, the value of the market has doubled roughly. And then, once we got to that point, the economy's firing pretty well. We've got stimulus, fiscal stimulus. We've got easy monetary policy. About a year ago, we probably were in a 50-50, right? It could go up, it could go down. And then as we sort of got towards the end of last year, my opinion, even before the Russian stuff started was, the asymmetry probably was a little more likely to go down than up. Again, nothing because more than we go in cycles, right? So we had this huge amount of demand, right? It was supply couldn't even keep up with the amount of demand that we had. So, the fact that inflation finally reared its head wasn't a shock. We know how central banks deal with inflation. They jack up interest rates, and that generally is going to lead to a little bit of a down cycle. So I'd say, if I was weighting the chance of it going up versus going down here, I'd say 60-40, it goes down, 65-35. And again, I think what investors need to do is, and I've been guilty of this my whole career. You can't just pick the top and the bottom, right? You have to sort of think about on balance. So that means shift your equity percentages a little lower. Even now, right? I mean, if you think about how much we're up in the last 5 years, anyone who's been in the market for the last 5 years is sitting on some pretty good gains. So scaling back your percentage of equities is probably not a bad thing. If we do get, higher interest rates, 4, 5, 6, 7%, that means in the next 12 to 18 months, you're going to have a chance to move some of your assets into fixed income at, decent returns. I mean, part of the problem is when rates are low, we all chase return by increasing our risk.
Right.
Now that rates are probably poised to go up, we can take a little risk off the table and then hopefully lock in some higher rates, via less risky assets as interest rates go up. But just, constantly be thinking about the balance of what's more likely to happen. And obviously where you are in your life cycle. Anyone who's had money in the market for the last few years has done pretty well. And even though it's down a bit from the highs, it's still a decent time to pare back a little bit.
David Sacco, everyone. David, thank you so much for your time and your perspective in these uncertain times.
Thank you for having me, Buck. It was a pleasure.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. That certainly stuff that we need to know. We need to stay current and thinking about all these topics, and we'll continue to do so, particularly in these times of high volatility and interesting times, as I called it earlier. By the way, Interesting Times is the name that I've given the Wealth Formula event. So I'm going to remind you again, don't miss it. This is a great opportunity to meet your colleagues and meet me. We always keep these events small, so you'll get a chance to get to know everybody and make some good friends. And come out April 22nd and 23rd, lots of things to learn. Lots of opportunities to see some of the assets that if you're in the investor club already, you probably own, and also an opportunity to socialize and make a lot of good new friends. So again, go to Wealth Formula Events with an S.com. Check it out before it's too late. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.